Let's look at our first question under cash flow and then see how we can solve it. So the consolidated statement of financial position of Scanners Limited Group as at 31st December 2014 and then the comparative for 2013 are shown as follows. So cash flow, they do what? They compare year on year account. So here you have 2013 and 2014. All right. So this is the statement of financial position of the company. Right. This is the statement of financial position of the company. You have PPE, goodwill, investment in associate, and then you have your current assets, inventories, accounts receivables, held for trading investments, cash and cash equivalent, held for trading investments. We also have equity, ordinary shares, capital surplus, retained earnings, non-controlling interest. We have non-current liabilities, as you can see them there. We have long-term loans, current liability, payables, income tax. Now, so these are the balances. So we also have profit and loss account of the Scanners Limited as at the present or the current accounting year 2014. As you can see them, we have profit before tax, we have profit for the year, we have profit attributable to the parent and subsidiary. We take note of all of them. Now we have additional information. This is what consolidated was statement of parent and subsidiaries. Take note of that. Now we have additional information. This additional information will also help us to understand much about the subsidiary company. Now, there were no disposal of property, plant, and equipment in the year. Depreciation charge in arriving at profit total 1,800,000. Scanners Limited acquired 90% ordinary shares of AT Limited on 1st September 2014 for a cash consideration of 460,000 plus the issue of 1 million ordinary shares of Scanner, which had a deemed value of 3.6 per share at the date of acquisition. This very paragraph, you should understand it. Do you understand it?
It's trying to explain the cash component used.
Okay.
Consideration.
All right. So that is how the Scanners acquired AT Limited. And now the below is fair value of net asset at asset acquired were as follow. So this is net assets. How do you understand this net asset?
The net asset.
When they are acquiring the company, there is a net asset.
That is telling you the total value of that entity at the date of acquisition.
Thank you very much. So net asset at acquisition, 3.4. Now, Scanners Limited made no other purchase or sale of investment in the year. The group policy is to value the net assets. Finance costs include interest on loans and any gains on held for trading investments. All interest due was paid in the year. Read the last paragraph again.
Finance costs including interest on loan and any gain on held for trading investment.
Do you understand? All interest due
was paid in the year.
Have you seen this held for trading? This held for trading is is a profit and loss item. Please come here. You will see it in in the state of financial position here. Have you seen it?
Held for trading. Yes, sir.
Held for trading investment. So when we say held for trading investment, what they mean, they are financial assets. You understand? They are financial. It could be financial asset, or it can be It can be financial liability. A company acquired or maybe incurred to for the purpose of selling. That's all. Do you understand? But the question you should ask yourself is this held for sale actually core business activity of the company?
Okay.
You understand? That's what you should ask yourself. held for trading, it means this particular held for trading is not actually a company activity. Because if it is a company activity, it will form part of the inventory. Do you agree?
Yes, sir.
So clearly it is not what? It is not something that is part of what of the company. So they are holding on to an asset for selling to gain profit. Are you with me? So you take note of this one, this thing. Are you with me? So are
Yes,
we
sir.
okay? Are we okay on everything here? Then I'll switch, then we start solving. So the question says, prepare
Yes,
consolidated
sir.
statement of cash flow for Scanners Limited for the year ended 2014. All right. Consolidated cash flow statement. They have the same principle with what? With the single cash flow statement. Same as single cash flow statement, but with a few additions. One addition is what? Is intra-group cash flow. Two is what? Consolidated adjustment or adjustment. That will be what? A non-controlling interest. Three, associates, if any. Four, acquisition and disposal of subsidiary, we call it undertaking. Impairment of goodwill. Few adjustments that are add-ons to what we already know in the cash flow. Are you with me? So let us go on. I believe you have an answer. So these are just a few adjustments that you see in the consolidated cash flow. Are you with me? So let's start. When you are coming to prepare, watch me. Listen very carefully. When you are coming to work on what or start your consolidation cash flow or cash flow, start with what? Workings. Start with workings to give you the fair idea of what the item does. Because when you are done with the working, the rest are just picking the values and coming and putting it there. Please go into the what? Go into the assessment of financial position of what? Of Scanners. Go into the statement of financial position of Scanners. So you take it item by item. Then you deal with the item one by one. Now, which item is first? And there's financial position.
PPE.
Thank you very much. Then you
PPE.
come here. One, PPE. You pick the PPE from the first one. You say purchase of PPE. Now, this purchase of PPE will go to where it is what? It's an investing item, investment activity item. So when you come with purchase of PPE, you want to find out whether at the end of the accounting year, the company bought an asset or they dispose an asset. So here you will start with what? Balance brought down of PPE. So you go into the what? Statement of financial position. In earlier accounting year, what is the balance of what? Of PPE. What is the balance of PPE in the earlier accounting year?
15,600.
Previous, thank you very much. So 15,600. So we'll bring it in. 15,600. Then you check whether the company has subsidiary. Under the company subsidiary, go into the company subsidiary. If the company subsidiary, when you acquire the company or fair value or acquisition net assets of the what? Of the subsidiary, what is the what? What is the value of what? PPE under the subsidiary? Let's go there. The PPE. Is the subsidiary having PPE?
Yes, sir.
How much?
800.
Then you will come and then add 800. You will come and add it. Then you ask yourself, did the company dispose of any PPE? You understand? You say maybe the company dispose of any PPE. In the question, let's find out whether they dispose of any PPE. When you read the question says that, what the question say about, did they dispose of any PPE? There is no disposal of PPE. Have you seen it? Item number one. Please, have you seen it? Please, have you seen it?
Yes, sir.
There is no disposal of PPE of what? Of the parent. Then you put that there. Is there any disposal of what? Of PPE of what? Of the subsidiary? We didn't see anything there, right? There's nothing. Like nobody disposed of, parent didn't dispose of PPE. So nobody disposed of. So it will not reduce the PPE value. Have you understood it? Is there any revaluation of what? Of an asset? Is there any revaluation?
No, sir, I'm not seeing a
There's no
revaluation.
revaluation of what? Of PPA. There's nothing like that. Okay. Then let's go on. Is there any depreciation of PPA?
Yes, we have depreciation
Where?
at the subsidiary side.
Okay, at the subsidiary, the depreciation is how much? 1.8, right?
Yes.
So you come and then less depreciation because you know that depreciation is less, right? How much? 1,800.
800.
Now, when you less it, what do you have? You add, apart from that, that is all that you work on what? On PPA. So what do you have?
Sir, 14,600.
14,600. Now, you add 14,600. Now you go to the what? The current accounting year, PPE. Current accounting year, what is the what? The current value of what? Of PPE.
16,800. 16,800.
16,800. Then that gives you what? Balance CD, which is what? 16,800. Balance CD, which is what? 16,800. Now, ask yourself, between the two, which one is what? Is higher?
The closing balance, sir.
The closing is balanced. Have you seen that now? The PPE, which was 14,600, has increased what? 16,800. What does it mean to you?
Then it means the value has gained.
It's not gain. It means the company has acquired additional assets. That's the meaning.
Asset. Okay. Okay.
It means the company has acquired, because the PPE has increased from 14,600 to 16,000. It means there's more. There's an in 20 as at 2013, it was 14,600. So now the PPE has increased to 16,800. It means it is what? PPE has increased. Are you with me?
Thank you.
By how much? 2,200. And this is investing activities. You understand? So this one will go towards investing activity. So it will go to investing activity. If it's going to investing activity, will it be in bracket or open bracket?
Since we are buying, it means we will take it out.
It means we will put it in bracket in the what? Investing activities. Is that not the case?
Okay. Yes, sir.
Good. Let's go to 2. Please, which item can you see there?
I'm seeing goodwill, sir.
Goodwill. So let's come to 2.
Thank you very much.
First, calculate goodwill of what? Of acquired assets. Do you understand? So first, calculate the goodwill. Now, how do we calculate goodwill? You will start with your what? Your purchase what? Consideration. Okay, so the next one is what? Goodwill, right? We are done with PPE, so we are now on goodwill. Now, let's go into the question. They said that the company acquired AT as a subsidiary. How much did they acquire?
They paid cash of 460.
All right, so
let's go on.
Okay, good. They paid in cash. Purchase control. They paid in cash. How much? You said 4.6 in the question, right? So let us break it down at 460, right? All right. So let's make it 460. Now the next item is that first they paid in cash 460, and second they also said that they issued.
They used shares.
You understand? They issue shares. So that is what share was issue or ordinary share. So how did they? What happened to it? They said that they issued the share at which price? They issued the share at the price of what? 350 pesos. 350 pesos at the date of acquisition. Now, how much did they allot there? How much is the number of shares? The number of shares is what? 1 million shares that they issued. So 1 million that they issue share to what? To the subsidiary. So that will give you how much? 1 million. Let us make it 1,000. Multiply by what? 360 pesos. When you multiply, what do you have? That gives you 3,600 here, right? So when you add, this becomes your what? Your total what? Purchase consideration. So when you add, what do you have?
40/60.
Thank you. 40/60. You know how to calculate goodwill. So the next thing is NCI fair value. You see, you ask yourself, is
Yes,
NCI fair value? In the question, they did
yes, sir.
they it's NCI fair value. Did they tell you the NCI fair value in the question?
No, 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 no. We didn't say anything like fair
So
value
that
on
means
SCI.
you use proportionate method to determine the what goodwill of what of the subsidiary. And I told you that we have two methods in doing that. Do you understand? We have two methods. Either you pick the parent to multiply by net asset at acquisition, or you took the subsidiary, you multiply by net asset, then you add it to this one, then you less the total net asset at acquisition. So let us pick the first one. Maybe you pick the what? The net asset. When you pick the net asset, you pick the parent percentage, which is 90%, because they said that the parent bought the subsidiary at which price? Percentage 90%. Then you multiply by what? By the total at acquisition. And at acquisition, they said the net asset of what of the subsidiary was for 3,400. Then you multiply by that. How much do you
3,400.
have? 3,400. How much is it? No,
30/60.
30/60. Now when you less it, what do you have? That gives you what your goodwill.
1,000, sir.
1,000. So this becomes what your goodwill. Or you can decide to use this option. You have your what? You have your purchase consideration. You have your what? Your purchase consideration. You have your what? Your cash, which is what 460. You have your what? Share exchange, which is what, as we did here, times 3.6. That gives you what? 3,600. When you add it, that gives you 40/60. That gives you 40/60. Okay. Then you pick the subsidiary. Then you say you add NCI. So you pick the what? Net at acquisition, net asset acquisition was how much? 3,400, right? Or you will pick the percentage of the subsidiary. Because if the parent is 90%, the subsidiary is how much? 10%. Then you multiply by what? 340, which is net asset acquisition. Just like it. When you multiply, what do you have? You will have 340. You add it, what do you have?
4,400.
4,400. Then you come and do what? Less net asset at acquisition. Net asset acquisition was what? Was 3,400. When you less it, what do you have? That gives you what good. What do you have?
1,000, sir.
1,000. So that is it. So which one that you think is easy for you, you'll pick to determine your what? Your goodwill. Now, after you get to know your goodwill, then you look for what? If the goodwill is impaired. Do you understand? So you check the what? You check goodwill impairment. So you say impairment. Now you know your goodwill. Then you see if there's what? There's impairment of what? Of goodwill. You've already calculated the what? The goodwill. So you check if the goodwill is impaired. So here you check it's a goodwill impairment. How do we check whether goodwill is impaired? So here you will
Yes,
start with what? Goodwill, or maybe balance brought down of what? Goodwill. Go into the statement of financial position. You'll see that they have goodwill at the beginning. Watch it. Have you seen it?
yes, sir.
Beginning is how much?
Beginning of goodwill is 2,400.
2,400. You understand? Then you add the current goodwill or goodwill for the year. So the current goodwill is how much?
Goodwill for the year is the 1,000 we have gotten.
1,000 that we've calculated here. So when you add it, what do you have? You have 3,400. Yeah, so this is your what? Your goodwill. Then you will pick your goodwill at closing. You will pick your goodwill
Yes.
at closing. Goodwill at closing is how much?
Goodwill at
Balance
closing is
closing is how much?
2,900.
2,900. So you come here, you have 2,900. Now you compare. Have you seen this goodwill? 3,000. Now it has reduced what? 2,900. What does it mean? What does it tell?
Then it means goodwill it has reduced. There's a reduction.
So it means what? It means
There's loss in value.
that's what we call impairment.
Impairment, yeah.
It means goodwill is impaired. That's the meaning.
Okay.
So what do you have?
500, sir.
Goodwill is impaired. You understand? Aha.
Yes, sir.
So now, if goodwill is impaired, where do we take goodwill impairment to?
In fact, we take it to operating.
We'll take it to operating activities. And
Yeah.
goodwill in operating activity, what happens to it? You see, when you are
Uh,
preparing profit and loss account, listen very carefully here. The opposite of what you see in the profit or loss is what? You treat it in what? In the cash flow. So goodwill in the profit and loss account, it is part of what? Administrative or expenses. You know that. And
yes,
because
sir.
it's not an actual business operating of the company, when you are bringing it to cash flow, what do you do? What do you do?
We add. We add.
Okay, so let's move to the third item. So
Invest.
whilst you are doing that, then you are taking note of
Yes.
these items. Okay, so the
Yes.
third item, sale and
We have investment
investment in what?
in associates.
Investment in what? In associates. So here, investment in associates. You know that when you invest in associate, when you look at the statement of, when you look at the statement of profit and loss account of did you see any associates? Did you see any associate shared profit in there?
No.
Hey, Charlie, it is there.
Is there finance costs down?
Finance costs. So you know where that one to what will go, right? Okay.
Yes, sir.
Before then, let's come here. The next item is what? Associate. So when you have associate, they will pay you what we call dividend. They will pay you
Yes, sir.
what we call dividend from the associate. Do you understand? Beyond the profit that they share, they give you, there's what dividend component that they will also pay, because the company halfly belongs to you. Are you with me?
Yes,
Because
sir.
if they will pay the parents, they give parents what? Dividend annually. You understand? Because 20%, whatever the company makes, 20% or 10% belongs to what? 10% belongs to, or so the associate
So
percentage is whichever the percentage the associate is with the parent, whatever the profit the company makes, they have what? That certain percentage in that period. Do you understand? That increases the value
yes,
of
sir.
what? Of the associate. But the dividend payment, they will pay the what? The parent what? Dividend every year. Okay. Just like owners of the company. The profit belongs to the what? To the owners of the company. However, annually they pay them dividend. Is that not the case? The same thing
Yes, sir.
applies here. So now, when you come to the associate, what you do, whatever you see in the what? In the statement of financial position, you will start with what? Dividend received. So dividend received from associates, you will start from what? Balance brought down. You go in the what? In the question, it's how much? Balance brought down is how much? Associates. Check.
77800.
7,800. Do you understand? Then you check. Did they give them any profit? Did they share any profit? So share
Of
of
profit.
profit. Check in the question. P&L. It is there. Did they share any profit?
Yes.
There is profit sharing. How much?
Share of profit of associate 500 Ghana cedi.
500. When you add it, what do you have?
83,000. 8300.
8300. Then you come and then what? Check if they have what? Balance CD at the end of the account here. What's the balance CD of the what? Of the investment? Closing balance. Go to the balance sheet or something like that.
8,000.
8,000. Then you compare the two. Now watch here. When you compare the two, what do you see? Check this. How much is the what? Is the total value of what? Of the investment in associates. Check it. 8,300. But
300.
at the closing or at the end of what accounting year, the balance carried down or
Has
value is
reduced
how much? It has reduced to how
by
much?
300.
By 300. That is the dividend that they received.
Okay.
We call it what? Dividend.
Thank you.
So this is the what? The dividend. So you realize that once the thing has what? Has reduced to this money, then that means what? The company received dividend. You see the whole thing. Because at the end of the accounting year, the associate value now is what? 8,000. Because at the beginning it was 7,800. and there was a share of profit which gave them what, up to 8,300. But in their final books, it is 8,000. It means 300 has gone into what? Into dividend that they receive. And the dividend received goes where? I told you, investment returns. Where does it go? This is investment, right? Investment from associates. So if the investment, then it will go to investing activity. It's investment. So they invested in another associate.
Associate.
All right. So when you invest in another associate, or even the name itself has made it out, investment. So one is an investment. Whatever the return that comes in, when you pay a dividend on your investment, it affects your investment activities. When you receive dividend on your investment, it affects your investment activities. Please, do you understand now?
Thank you, sir.
But anything that relates to equity, shares, bond, loans will go under the umbrella of what? Financing
Finance.
activity. All right. So
Thank
this
you.
one is what? Is investing. So whilst you are doing that, you can what? You can label it. This one is what? I told you what? This one is what? Operating. This one too is what? This one too
500.
is what? Operating. PP is not operating.
No, PP
PP is
is
what? Investing.
investing.
Activities. Okay. So that it will not, you will not get lost on that. Okay, let's go. The fourth one is what, please?
The fourth, we are coming to current liabilities, sir.
So the current liability, this is what we call. So you say changes in what? In working capital. It will be simple for you like that. So you first come with your inventory. You have your payables, right? Like that. Simple. So you come here, your opening balance for all of them. Give me the values.
Okay.
Balance brought down. Inventory is how much? Let's go there.
12,000.
Okay, so let's go to inventory. Inventory opening is 12,000. Inventory is 12,000. Receivables is how much?
Receivables is 8,200.
8,200. Payables is how much?
Payable is 10,200.
Payable. Yeah, 10,200. Payable is 10,200. Now let's see if when you acquired subsidiary, do they have inventory? Do they have payable? So you compare. So you just follow the process. You understand? You when you pick every item. Have you seen how I'm taking you through step by step?
Yes.
You understand? All the items, when you pick them one after the other. Go into the question and then find out if the newly acquired company has inventory. Do they have inventory?
Yes, sir.
How much?
2,200.
2,200. You come and add it here. Do they have receivables?
Yes, sir.
Receivable is how much?
700.
700. You come and add it here. Do they have receivables or payables?
Payables, yes.
How much?
500, sir.
500. Then you also come and then add it here. You understand? Now, did the company dispose of part of what subsidiary? Any disposal?
They said there were no disposal of property.
Now, if there is any disposal, if they dispose part of what of the subsidiary, it may affect the receivables values and payable values here. But they say they didn't dispose anything of. So you add it up. Something. What do you have?
14,200.
All right. So this one is 14,200. This one is how much? This one will give you 8,900.
9.
Okay. So the last one is how much?
10,700.
All right. So 10,700. Okay. Now, when you are done, then you check it out. What do? You will come here. You will bring the balances, right? So you'll bring your balance carry down here. So when you bring a balance carry down, closing balance for inventory is how much?
Closing for inventory is 11,600.
Okay. So the inventory 11,600. Okay. So you have 11,600. Receivables is how much?
Receivable is 9,400.
Let me confirm 8,700. Good. Okay, so you have it here like this. Now you are coming to do the comparison. Now let's look at what inventory. Inventory initially it was what 14,200. Have you seen it?
Yes.
Now it was 14,200. Now it has reduced what 11,600. Is it increase or decrease?
It means inventory
Is
stock
it
is
increase or decrease?
stock has
Oh,
decreased.
it has decreased. So the difference is how much? Decreased by how much?
2600.
Increase or decrease? So 2600. So once it has decreased, it means cash is coming in. You understand? It has decreased. So inventory has decreased. It means they sold part of their inventory. So the inventory now has reduced to 11,000. So that means cash is coming in. So when you go to what your operating activities, what do? You open bracket for what? For inventory. Are you with me?
Okay.
Do you understand this?
Cash is coming in. You gave an explanation in the initial submission. Here is the case we have inventory, that is stock, that will take time to be turned into cash. But here is the case that at the end of the year, we have inventory going down by that amount. So that cash needs to be taken out from the activity because it's the main call. So give me a check, I beg you. The 2,600 that
Oh,
you were
I'm
asking.
saying that assuming you have inventory. So inventory is like the goods that you sell,
Yes.
right? So if you have goods worth like 20,000,
Mm-hmm.
do you understand? So here you have cash trap here. You call it cash what? Cash trap in your inventory. So this is your goods or your inventory. 3 months later, the inventory has now reduced to what? 15,000. How much is gone out of 15,000?
5.
So 5,000 sold. So when we sell 5,000, it turns into what? Cash.
Cash.
Do you understand? So this is cash, which go into the what? Into the cash flow. So that is the
Yes.
difference here. That is what we are. That is the what you are seeing here. So initial the inventory is what 20,000. Now it is now what 15,000. The difference of what 5 is what is cash. You have sold it.
But you were saying you less it or something of the sort.
You less which one?
The cash. You
Oh
say when we go to
no, I say
the
you will add it to what you
ah,
open bracket. That's what I'm saying,
thank you. Oh, you open. Thank you, sir.
right?
Sorry, sir.
You open bracket so that it will be added to the cash.
Thank you, sir.
You understand? Okay.
Mm.
Now let's go to the the receivables. Now when
Receivables.
you look at receivable is what 8,900. Now at the end of the account here, it has increased what 9,400. What do you say about this?
We are to receive 8,900.
No, it's not receive. Receivables. Receivable is what? Like your debtors, right?
Yes.
Your debtors
So
value is
so
what?
we are anticipating that a debt of 8,900 at the end of the year should even go. But here is the case that at the end of the year, we are having an addition to that 8,900.
So what does it mean?
That means our money is gone.
No, your money is with what? With other people. It means the
People, yeah,
money that you don't have the money. You have the money in debt. So it means
debt,
your
yeah,
money is what? So it means your cash is what?
it's trapped.
So your cash is what? Reducing. So the difference is how much?
500, say.
500. So this you go to the what? Operator there you put it in bracket because once your receivable is increasing, it means your money you don't have the cash. Your money is with what? With other people, but you have it as a receivable. Let's go to payable. Payable, you are supposed to pay off this money. Are you with me? You are
Yes,
supposed to
sir.
pay 10,700. At the end of accounting year, your payable is 8,700. What does it mean?
It means you paid more than what
So
you have been.
no, 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 no. It doesn't mean that you paid more than you are supposed to pay. It means your payable has reduced to 8,700. It means you've made part payment of what? Of your
Payment.
payables.
So money is gone.
So money is gone. So what happens? If money is gone, what happens?
If money is gone, it means your cash will reduce.
Absolutely. So what do you do? What's the difference, please?
2,000, sir.
2,000. So what does it mean? It means the company is paying money out from what? From the company. Money is
Company.
going out. Once you are paying, money is going out. So it will reduce your cash flow. So we are done with what? Operating
Working capital.
working capital. So operating. So which item can you see down there? Again, please.
Held for trading investment.
So the held for trading whatsoever. So we call it held for trading. So that held for trading, please. The opening is how much? So balance brought down. Check is how much? Held for trading.
1,800, sir.
1,800. Have you seen it? Held for trading. 1,800. Now, and the closing is how much?
It's 1,400. No, sir, please. Held for trading, please. Let's go back. The balance
You said the opening balance held for trading is what? It's
is
1,800.
4,100.
4,100. Held for trading.
Yes, sir. 1,008. And the closing is 2,200, sir.
So what is the difference? So you said the closing is 2,200, right?
Yes, sir. The difference is 400, sir. 2,200.
2,200. Here, where will you treat this man? What did I say there? What did I say? What did I say? What did I tell you about this?
Held for trading.
Yes.
It will be operating activity.
Yeah, but I'm saying it will be operating activity. How do we treat
it? It is not a core business activity. So since it's not a core business activity, we need not to add it back.
So what do we do?
So we have to take it out. We subtract.
We subtract. So which figure are we going to subtract? That is all that I want.
The 400.
Okay, difference. So you realize that you have what 400 here. So this is what on asset held. Do you understand? So gain on what on asset held or trading activity is 400, and you know that whenever there is gain, it affects your profit and loss account. Do you know that?
Yes, sir.
Do you know that it affects whenever there is a gain, the gain will affect your profit and loss account as income. You understand?
Yes.
So when that happens, what do you do? So this one too will go to it. It will go to operating activity. And this one you less it. Are you with me?
Yes, sir.
You less it. Okay. So the sixth one, what do you see over there?
Cash and cash equivalent.
Good. You skip that one. That is what will finalize the whole thing. Right? Okay. So the sixth one is what?
We are going to equity.
Okay, so under the equity, what do you see first?
We have ordinary shares.
So under the equity, you have what? Ordinary shares. And I say ordinary shares falls under what?
Financing activity.
Thank you very much. So you have here what? Ordinary shares. Okay. The ordinary shares balance brought down under the ordinary shares how much?
10,000, sir.
So let's go in there and let us see. The ordinary shares is what? 10,000. Okay. Right now, let us go into the question and then find out whether we issue share to other shareholders. Is there any share that we issue to other persons? Did we issue any share to other persons?
When we were buying,
when we were buying a subsidiary,
the new company,
we issued what 1 million shares in cash. We multiply by what 3.6. That gives you what 3,600. It is here. When we are calculating for the purchase consideration, this figure we issue, so 3,600. So you come here, you say to what? To subsidiary, which is how much? 3,600. When you add it, what do you have? So these are the total share that you have. Okay, so you have what? How much do you have?
This is 10,000, so 13,600, sir.
13,600.
Yes, sir.
Then balance carry down.
Shares 14,800, sir.
So now compare the two. As the company issued, compare the two. Have you seen that? At 2013, they have 13,000 equity. Now the equity has increased to 14,800. So what does it tell you?
It
What does it tell
means
me?
we have issued more
Thank you. So that's the
shares
mean.
at
So
the
how
end
much
of
is that?
1,200, sir.
1,200. So this one will go to what? Finance. Do you understand? So this
Yes,
one
sir.
will go to finance activity.
Equity.
And because it is a gain, remember that. So you open bracket for it. Do you understand?
Bracket.
Okay.
Yes, sir.
So what do you see over there? Seventh one. What do you see over there?
The next one is capital surplus.
Okay, capital surplus. Now, capital surplus, check. Balance brought down is how much?
Balance brought down is 400, sir.
Capital surplus. Balance brought down is what? 400. Okay. So you have what? 400. Capital surplus
In the
is how
uh,
much?
the same 400.
400. So you bring 400 here. So here will be what? 00. Nothing.
00.
You understand? Aha. So capital surplus will not come there. Do you understand? You will meet capital surplus in your what? In your cash flow. You will not bring it. Do you understand?
Okay.
What's recorded 0? So the 8th one is what? What do you have there?
Retain earning.
Retain earnings. Okay, so under the retain earnings, what do you see at the beginning?
We have 6,300.
So under the retain, and be very careful here. So under the retain earnings, we will have what we call dividend paid owners. Do you understand? So under the retain earnings, and you understand, you know what the essence of retained earnings, whatever the receivables in terms of cash come to retained earnings. So here, whatever the retained earnings suggests, it means money is coming in. All the dividend that the company will receive will go into what? Into the retained earnings. So here you say what? Dividend received by what? By the parents. You understand why it is so. So here, pick the dividend received. Dividend. You see balance brought down is how much? Balance
Retain
opening balance is how much? Retainer is how much?
6,300.
6,300. Did the parent receive any reward at the end of the accounting year? So here, the parent. So this is for the parents. So here, go to P&L. You see the what? The profit share, the profit that they shared. Parents, how much did the parents receive? 1,200. Have you seen it? You understand? So when they share the profit, that's what the parents receive. So that is it. So you say what? Profit attributable to what? Or profit shared. How much the parent receive?
1,002.
1,200. You add it. What do you have?
7,500.
7,500. Then you close it. So balance CD is how much? Check. So the balance CD of parents is how much?
7,
Seven.
300.
So now 7,300. Have you seen that? At the beginning, this is the value of what of the parent. Now it has reduced what? 7,300. It means part of their money is what? Is issued as what? As dividend. Please, do you understand?
Yes, sir.
So the difference is how much? I think
200, sir.
200. So dividend, right? So here, this one goes where? It goes to
Dividend
finance.
finance.
Now, once it's what? It's a dividend that the parent is receiving. Is it negative or positive?
Parent is receiving. This will be
Yes.
positive.
Dividend received by the parent. So if the dividend, you see, dividend, when you pay dividend, it's money that is going out.
Yes.
Or have you forgotten?
Yes.
Or let me caption it well here so that it will be more, because the moment you see the retained earnings increases the value of what of the company. The moment it reduces, you paid what? Dividend out. And when you pay dividend out, so dividend paid to owners of the what? Of the parent. Your retained earnings has reduced to I've used 7,300. It means you paid what? Dividend. So when you pay dividend, what happens? It means your dividend has to do. If you paid, it means you are paying out.
The money is going.
The money is going. That's a dividend pay. So retained earnings. You have seen the retained earnings has reduced in value. It means it means dividend has been paid out. Do you
Sure.
understand? So you take note of that because yes, this retained earnings. You understand?
Okay.
This is the retained earnings. So you take note of that. So the moment your retained earnings is what is reducing, it means you are paying money out of it. So it will reduce your cash flow. What again, please?
Non-controlling interest.
Non-controlling interest, NCI. Now let us first, before we calculate for non-controlling interest, we determine that let us look at the value of what? NCI. So you have what? Your non-controlling interest. So let us know the value of what? Non-controlling interest. Now we know that the assets, non-controlling interest is not fair value. You remember? That's why we use proportionate method, right? So the NCI is not fair value. So in order to determine what the NCI of auto company, you say what? Net assets at acquisition. Then you pick the percentage of our subsidiary. Then you multiply by what? By the net asset at acquisition, which is what? Well, the net asset at acquisition is how much? Net asset at acquisition is how much? It is here. You check them.
340 times 3,400
3,400. Okay.
times
3,400. What do you have?
that is 340.
Now, share of profit. Now, when we look into the word P&L of what? Of the company, you realize that they've shared the profit among subsidiaries and the parent. Have you seen it? Check.
Yes,
have you
sir.
seen it? It's how much?
Share of profit.
190. 190. So when you add the 190, what do you have?
530, sir.
530. So this is the actual value of what? Of the subsidiary. Please are with me.
Yes,
sir.
The
actual value of the subsidiary. Now you are down with what? Knowing the actual value of the subsidiary. So you check whether they've paid what? Dividend to what? To the shareholders of what? NCI. Do you understand? So here you say dividend. You see parent. We've done with what? With the parent. Now let's look at if parents subsidiary have also paid dividend. Non-controlling interest people. So if their value reduces, it means they've paid. So let's look at it here. So go to what? PN statement of financial position and check the non-controlling. Beginning is how much?
beginning is 6,100.
6,000. So that's balance brought down is 6,100. And now for the year, have you seen that we've just calculated it? The value of what? NCI. So the current NCI is how much? 530. You add it. What do you have?
6,630.
6,630. Now check the what? Balance CD. How much is it? Balance CD is how much?
6,500.
6,500. Which means, have you seen that? Now the closing balance is less. What does it mean?
The closing balance is less.
It's less than the beginning. What does it mean? What does it mean?
The closing balance is less than the beginning.
The beginning, please take the analogy here. I inform you that look at the opening balance for retained earnings. Retained earnings was 7,500 and at the closing is 7,300. It means the company paid shareholders dividend.
So NCI has paid, we have paid some interest owners of NCI some money.
So what does it mean?
Money is gone out.
So you say dividend paid. Oh, that's what I want you to say. So if dividend is paid, what happens? What happens to us? Dividend finance cost. So how much did they pay?
130.
130. It means money is gone. So they've paid. So this one will also go to finance, right? Yes. It will also reduce what? Finance. Please, what again?
The next one, we are going to non-current liability.
Okay, so which is what? Which is the 10th one, right?
Yes, sir.
What again? What can you see? Another non-current asset. What item can you see there?
Long-term loan.
Okay, so you have loan. So loan, what do you see? Loan.
Balance BD.
So balance brought down. Loan is how much? Loan is how much? Come again. 18,400.
Yes,
Okay.
sir.
So 18,000 like this.
Yeah, flat.
Flat. Okay. Now there's no additional information on the loan. So what do you see? Closing is how much?
Closing is 14,000, sir.
14,000. It means the company has paid part of their loans.
Yes, so money is gone.
You understand how much?
4,000.
4,000. So this one to loan, all of them goes what?
Finance.
Finance what activities. So I want to it will what? It will less. Please, what again? What item do you have again?
Current liability.
Current liability. We've dealt with that. Have you forgotten?
So income tax, sir.
Income tax. Income tax. Good. Income tax. So the fifth one is what? Income tax. Now the income tax. What do you have? You have go into the balance sheet. You see balance brought down. Income tax. Check. How much is the income tax? Now
Income tax is not, sir.
900. Now check if subsidiary is
Yes,
also paying tax. Check if subsidiary is
yes,
also
it's paying
paying tax.
600. 600, sir. Income tax, please go there. Profit before tax.
Uh-huh.
The next one.
Charge for the year. You are telling me you are talking about charge for the year. Income tax charge for the
Yeah,
year. Charge for the year is what? It's
600, sir.
600. You add that. Do you understand? And I'm saying that check if the subsidiary has any tax. Subsidiary. I didn't see any tax
And,
on what? On
mm,
subsidiary. So that one is zero. Disposal of what subsidiary. If you dispose subsidiary, that particular asset that you dispose, if there's any tax component affecting that disposal, you will also bring it here. But there's no disposal. Then close it. What do you have? So this plus will give you 1,500. Okay, so balance CD is how much, please? Check. What is the balance CD?
to give me
Balance CD
9,
is how much?
but 600, sir.
Okay, so balance CD is 600 in the books. So here, the difference is what? It means, have you seen what happened here? Have you seen the income tax is 1,500, but closing balance is what? Is 600. So how much tax have they paid?
They pay tax of 900.
Thank you very much. So this one, it goes where?
Income tax, operating activity.
Operating. Okay. What again, please? What item can you see there?
Oh, we are done.
We are done. So there's nothing under this one again, eh?
Yes.
Oh, okay. So let me check. Okay, so it is done. So you are done. So all that you have to do is that then you'll come and then what? Start your what? You'll come and what's the name of the company?
Can na Scanners.
So you have your scanners limited. So you will start with your consolidated what? Cash flow statement for the year 31st December 2014, right?
Yes,
All
sir.
right. So you are done here. So here you start with your what? Your operating activity. Under your operating activities, I said you start with your what? Start with your operating profit before interest and tax. So you go into the word P&L and then find out profit before interest and tax. Can you see it? What I can see is the
Yes.
profit before tax. That's what I see over here. Have you seen it? It means
Yeah.
what? What does it mean?
You have to go back and add up to
Absolutely. It means this thing is what taken away. So here, so you'll bring your what?
interest.
1,900. 1990 here. Then you what? You will come and do the what? Your adjustment. Is that not the case? So here,
Yes.
because it is what profit before tax, you remove the interest here. You understand? So profit before tax, interest is not part of this. So you come and do your what? Your adjustments here.
Adjustments. Okay.
Now your first casualty is what? Is the what? Is the finance cost that they did not, the finance cost that they remove, right? The interest I'm talking about. Have you seen it?
Yes, sir. Yes, sir.
450. You come and add it back. They didn't add. So you come and add 450 back here. Then now you can now do all the adjustment that we are talking about. Now, let us look at our first item is what? Depreciation. Right. So you go in there, you'll find out if there's any depreciation in there.
Yes, sir. During depreciation.
Depreciation is how much? 1,800. As they said.
Yes.
Okay, so that means they less it, so you come and add it back. That's all.
Yes,
Then you go into the P&L. You see that I've seen that they've also less share of profit of associates. Have you seen it?
yes, sir.
P&L. Check it. Then you have to come and add it back. So share of what? Associate. Please, how much? 500. Add it
Oh,
back.
yes, sir.
No, you don't add it back. You less it because they added this 500 onto their what? Onto their income. Do you understand? So once
Oh,
they
yes,
added
sir.
it as an income, which form part of their profit, you remove it. So you less it.
Okay.
Because it's not part of actual business activity that should give them that profit. What item can you see in the P&L? On the face of P&L, what item can you see again? We've dealt with fixed
Uh,
costs, we've dealt with share of profit, and we deal with depreciation. We are done with all that. Is that not the case?
yes, sir.
So we are done. So now, because we are preparing consolidation, there are other items that you may not see on the face of P&L. You've already calculated it here. I could remember one for you, which is what? Which is impairment, goodwill impairment. Have you seen it?
Yes.
Goodwill impairment. Have you seen the goodwill impairment? What do we do with goodwill impairment?
The 500. Number two.
What do we do with it?
We are going to add back.
You are going to add back. So you have a goodwill impairment, add back 500 goodwill impairment. Now there is also held one item which is what? Oh, is a hill for trading. Have you seen it?
Help. Yes, yes.
Yes.
You, you spoke.
It's a gain to the company because they have another item that they are selling for profit. Right? So if it
That one,
increases, so gain,
400.
gain on what? Gain on held for training. Now it is 400 because it's increased their value. What do? We have to do
We
what?
take it out.
We take it out.
Reduce.
So 400. So I think these are the adjustments. Because when we look at it, so these are the adjustments that will come here. So we've done with goodwill operating. We are done with that. What again? Changes in working capital will come later. Held, we've done with the held for trading. Income tax, we also deal with it later. Okay, so we are done. So please add this one and let us go and then
3840.
3840. So let's move. We have 3840. Okay, so let us move. So when you add it, what do you have?
No, sir.
Yeah.
I subtracted it straight. Oh,
No.
I should bring this one to this side.
No. I'm not saying that. I'm saying add these and then add it to 1940. That's what add this and give me the value. That's what that I'm saying.
Okay, sir. Please, I'm coming. 1850.
50. Now, when I add 1850 to 1990, that gives me 3840. Okay. Okay. All right. So that gives me 3840. Okay. So let us now look at changes in working capital. Okay. So changes in working capital, they are the what? First one,
The
let's go in
inventory.
the inventory. So the inventory, is it increase or decrease?
Inventory.
What is it? Inventory
Two.
is what? Decrease in inventory, right? So you have decrease in inventory. So decrease in inventory, you what? You will add it, 1,600. Then let's go to receivables. Is it increase or decrease?
That one, it has increased.
Increase. So increase in. receivables. Okay, so now receivable increase in receivables. How much is it? How much is increase in receivables?
500.
Okay, 500. It has increased by what? Increased by 500. So it is negative. You put it in bracket. And then decrease in what? Payable.
Payables.
It has decreased by how much?
2000, sir.
Okay, so 2000. So that one too has decreased. So you put it in bracket. Money is going out. Okay. So after that, you add this. So that gives you what? Cash flow from operating cash flow. Okay, so what do you have?
Okay. 3940.
Good. So you have 3940. So this is your what? Your cash flow from operating activities. Right? Now you have interest to pay. Right. So how much is the interest to pay? So the interest is what? Interest or finance costs. They are the same. You understand?
Yes, sir.
Interest or finance costs. When you look into the question, the interest or finance cost is 450. Do you understand? Okay. It is in the question. Finance costs 450. Then you bring your what? Your tax. Tax paid. We did the calculation here. How much is it? Here. Have you seen it? How much?
Tax we paid is income tax, please. I'm coming in.
I'm showing. Can you see the board? I've already shown it to you. You
900.
see board. 900. 900. Okay. That's all. So when you sum it up, what do you have? So this gives you what?
Minus
Net cash flow.
450. Minus 900. 2590.
Okay. So 2590. Then you bring the 2590. Good. It's positive figure. Okay. Then let us go into what? Into the next one is what? Cash flow from investing activity. Now, first one, remember, we started with what? With net assets. What do you call it? PPE. You remember? The first one, PPE. What do we get? We got what? Investing activities, which there's an increase in what? PPE. Have you seen it? Okay.
Yes, sir.
So you say purchase of what? PP, which is how much? 2,200. Because we increase it, it will be in brackets. Are you with me? Okay.
Yes, sir.
The next item, you brought those. The next item is what? Investment activities. What are the activities that comes under investment activities? Please show me, show me, show me, show me.
You said disposals and purchases.
Investment activities. What are the items that
Disposals
flow?
and purchases.
Disposal. That's not. I didn't say any disposal. I didn't say anything about disposal here. Please. What is
Yeah.
coming here? What is coming here? What is coming here? Check here. Dividend received from associate. Dividend received from associate. Have you seen it? Investing. You invested in another
Yeah.
company. You receive dividend. Okay. So dividend received from associate. So dividend received. Dividend received from associate. How much? 300. It is a positive figure. What again about investment? How many investment issue did you deal with? How many investment issue did you deal with?
Investment issue. We did two. We have dividend too.
Dividend. Hey, dividend.
What we
We only did a PPE and then what? And then associate. They are the only
yes,
activity that we did. They are the only
yes, sir.
investment activity that we did, right? Okay. Okay. So they are the only activity that we did. Now watch here. Come here. Have you seen the subsidiary? Have you seen the subsidiary has cash?
Yes, subsidiary has cut.
Have you seen the subsidiary has cash? How much cash does it have?
Yes, sir. 200.
200. Okay, so how much did we buy? How much did we acquire subsidiary in cash? Have you seen it? So you come here, watch here. When you see, look at it. The acquisition. Where is it? Purchase consideration. Have you seen that we acquired the company in cash and one in shares? Have you seen it?
Yes, sir.
So this cash, we paid for the company 460. We paid for the company. So here, what we
Yes.
have to do is that here you balance it. So you have here, this one will give us 12. So let's see, acquisition, subsidiary. Now, when you look into the subsidiary, have cash balance. How much? Do you
200.
understand? And then purchase consideration of this subsidiary is how much?
460.
460. You understand? Because the parent is taking over. So how much balance? How much is it going to cost the parent actually?
660.
No, it's going to cost the parent 260.
Why? 260. He paid 200 though.
The subsidiary has cash balance of 200.
Sir, I've seen it because it was not in bracket. That is why I was a bit
The
confused.
subsidiary
So let's
has
go.
cash balance in 8 books, and you acquired it at 460. Clearly, the actual cost is what? Is 260 because you are going to take over the 200. Do you understand? Okay. So all of them comes under what? Under the investing what? Activities. Okay. So you have what? Acquisition of what? Of subsidiary. So which is what? 460 minus what? 200. That gives you how much? Negative 260. Yeah. Okay. So what
Yes.
else? So that is all about investing because apart from these, we didn't have any investment activities up there. Please add it. What do you have?
2240. No,
Add
wait.
the
Oh,
negatives. So you
wait.
have
It's sorry.
okay, you have 3.
Negative. It will be negative, sir.
Negative what?
2160.
Okay.
Negative.
So that gives you 2160 negative. So we are done with what? Investing activities. So let's go to so this one, let me put it here. So that let me caption it. So that gives you 2160. Okay, so that gives you what? Net cash flow from investing. All right. So let's move to financing activity. Okay, so let's move. So financing activities, you remember we did a lot of calculation under financing activities, right?
Yes, sir.
Which one can you remember?
Issues on equities.
Go to the calculation that we did here. You'll pick all the with we'll pick all the information here. So come here. We start from where do we start from?
We started
Okay,
from
so
PPE. Two is good, bro.
we start from ordinary shares. Have you seen the ordinary share
Yeah.
financing activities? Which is what? 1,200. It's
Yes.
an increase. So you come here. It's an increase, which is 1,200. Then you go there again. Which item again? Can you see the after share? You come here. Dividend paid to
Yeah.
owners.
Uh-huh.
You understand? It reduce your what? Your receiver, your retained earnings. How much? 200.
Earnings.
Right? Then you come here. That is what? Dividend paid. So how much? That one is what? 200. You put it in bracket like that. And then what again? You go there again. Dividend paid. Then you go there again. Then you come to NCI, dividend paid to what? Non-controlling interest, 130,
One
right?
trace.
That one too is negative, 130. Okay. And which item again? So 130. Then you go there, you go there after this or there's a loan. You understand?
There.
So they paid
Got them.
loan. So loan
400.
paid, right? So you have what? Loan payment. Right? So how much did we pay? We paid loan of what?
4,000.
4,000. You put also that one too in bracket. And then you go there again. What can you see? From there, we came to operating profit. We done reading operating profit. Then we are done. Is that not the case?
Finish, sir.
Finish. That's all.
A
So
roller.
you balance it off. So here, then you also come and have your what? Net cash flow from financing activity. How do you have? I have this from.
3130.
Is it bracket or
In bracket.
okay, 3130? Okay, so you sum them up from operating 2590 minus 20. You are at 2160 plus 3130. Okay, minus
2700 minus
minus
2700.
2700. Good. So here, so this gives you what? Net cash flow. All right, so minus what? 2700. Good. Please have you seen that?
Yes, sir.
Good. So let us do small exercises. So when you get to this point, then you see the opening cash balance. How much is your opening cash balance? Go to the P&L, statement of financial opening. Go to the statement of financial position. Go to the cash and cash equivalent. What can you see there?
4100.
4,100 opening cash balance. Have you seen that? 4,100. So you add the 4,100 to this. What do you have? What do you have?
1400.
1,400. So this is 1,400. So this closing cash and cash equivalent. So if you do it like this, and it didn't balance with what you have in the profit and loss in the system of financial position, then your answer is your calculation is wrong. Have you seen the closing balance for? Have you seen the closing balance? Like, have you seen the
Yes.
closing balance for cash and cash equivalent? How much is it?
1400.
How much is it?
1400.
Is it the same as this one?
Yes.
So if your closing cash and cash equivalent is not the same as the closing that you have in the question, then your answer is wrong. Please, do you understand?
Yes, sir.
Any question so far? Any question?
No question. No question, sir.
So we are now coming to do analysis of cash and cash equivalent. So okay, so this one it is simple. It will just bring your balance brought down. It will bring your balance carried down here. That you bring the changes that it brings. So here you start with what your cash that you have. Your opening balance cash is how much? You said it's 4,100. Closing is what? 1,400. So what is the changes is what the negative 2,700 that you see over there. Please have you seen it? Have you seen it?
Yes, sir.
Your net cash flow. So that's the analysis. So yeah, you have your balance brought down, your cash 4,100, and then the closing is what 1,400. The changes in it is what 2,400. Do you have overdrafts in the question? No. Do you have bank accounts in the question? No. Do you have a treasury bill in the question? No. If you have bank, you will bring that one to here. We don't have it. If you have maybe overdraft,
Okay.
you also bring it here. We don't have it. Or if you have maybe T-door, we don't. Okay, so that is it. So at the end of the day, you close. We have already balanced the account for you. I have already balanced the account for you. So that is it. Any question? Any question, please?
No question, sir.
Is everything okay? So if everything is fine, then thank you very much.